Hi friends, this is Arundhati Bajpayee for Tax Publishers, and in today's session we are going to talk about corporate social responsibility. Corporate social responsibility, or CSR for short, is an obligation of corporate towards the society from which they have derived their benefits. CSR can be seen as a commitment given by a company to the society at large to behave ethically and work for the betterment of the stakeholders by improving the quality of life of the workforce and their families, and contribute voluntarily for the benefit of the society and a sustainable environment. Why is CSR important for the company? Company having CSR framework tend to have a good public image. It throws positive light on the organization, which builds positive brand reputation. CSR policy builds trustworthiness among employees, which result in talent retention. Provides a competitive edge and easier access to raise capital. Applicability of CSR in India. Section 135 of the Companies Act 2013 mandates that every company whose turnover was rupees 1000 crores or more, or net worth was rupees 500 crores or more, or net profit was rupees 5 crores or more, during the immediately preceding financial year shall constitute a corporate social responsibility committee of the board consisting of 3 or more directors, out of which at least one director shall be an independent director. If a company is not required to appoint an independent director under section 149 subsection 4, then CSR committee should have at least 2 directors. The composition of CSR committee shall also be disclosed in board's report as per section 134 subsection 3. Further, in case of a foreign company, the balance sheet filed under section 381(1)(b) of the Act shall contain an annual report on CSR. Provided that once the provision of CSR is applied to the company, then the company is liable to follow the same for 3 years, despite of the fact that limits given under the section has not exceeded in subsequent years. Expenditure on corporate social responsibility. The company in every financial year shall spend at least 2% of the average net profits as calculated in accordance with provision of section 198 made during the 3 immediately preceding financial years. If the company has not completed 3 financial years since its incorporation, then the provision shall apply for proportionate number of financial years held since incorporation. The expenditure of CSR as per Finance Act 2014 will not be a part of business expenditure, nor deduction will be allowed for the same while computing taxable income as per Income Tax Act 1961. Set off of excess CSR expenditure. According to Rule 7, Sub-Rule 3, the excess CSR amount shall be set off within next 3 financial years. However, any surplus earned from CSR operation should not be included in excess CSR amount. The aforesaid provision will be applicable on prospective basis with effect from 22nd January 2021. Hence, excess amount of CSR spent on or after 22nd January 2021 will be considered for the financial year ending 31st March 2021 to be carried forward for being set off during next 3 financial year. Surplus generated through CSR. Any surplus earned from CSR should not be included in business profit. It shall either be transferred to the same project, deposit in unspent CSR account, or transfer to fund specified in Schedule 7. Administrative expenditure in CSR. As per company's Corporate Social Responsibility Policy Amendments Rules 2021 introduced by MCA On January 22nd, 2021, Rule 2, Subrule 1B defines administrative overhead as an expenditure incurred for general management and administration of CSR functions, excluding expenses incurred for designing, implementation, and evaluation of particular CSR project or program. Rule 7 provides that the expenditure on administrative overhead should not exceed 5% of total expenditure. Penalty provisions. If the company fails to spend such specified amount, then the board report of the company should specify the reason for the same. Further, transfer such unspent amount in the following manner. If the amount spent does not relate to any ongoing project, such unspent amount should be deposited in a fund specified in Schedule 7 within 6 months of the expiry of the financial year. If the unspent amount relates to any ongoing project, such unspent amount should be deposited in unspent corporate social responsibility account, being special account opened by the company in a scheduled bank within 30 days from the end of financial year. Such amount should be spent by the company towards the corporate social responsibility policy within 3 financial years from the date of such transfer. If a company fails to spend such amount, then transfer the same to a fund specified in Schedule 7 within 30 days from the date of completion of the 3rd financial year. Punishment and fine. If a company defaults in complying with the provision of Section 135 subsection 5 or subsection 6, company shall be liable to a penalty of twice the amount required to be transferred by the company to the fund specified in Schedule 7 or the unspent corporate social responsibility account as the case may be, or rupees 1 crore, whichever is less. Every officer in default shall be liable to a penalty of 1/10 of the amount required to be transferred by the company to such fund specified in Schedule 7 or the unspent corporate social responsibility account as the case may be, or rupees 2 lakh, whichever is less. Reporting of CSR compliance. CSR 2 is a comprehensive web-based form which is submitted to registrar about CSR activities of a company performed during a financial year in a detailed manner. The MCA has notified that every company covered under Section 135 subsection 1 would require to furnish a report on corporate social responsibility in form CSR 2 to registrar of the companies. Thank you.